Hello everyone, today we're going to be talking about what a credit score is, how it actually works, and how banks determine your credit score. So a credit score is going to be a number between 300 and 850. And whatever number you have, this determines your credit worthiness. The higher your score is, the better you look to a potential lender. Your credit score is determined based off your credit history, the amount of accounts you have open, your level of debt, your repayment history, and a bunch of other factors. So a lender uses a credit score to see if you, the borrower, will repay them in a timely manner. There are 5 categories that people will fall under depending on their credit score. A poor credit score is anywhere from 300 to 579. Fair is anywhere between 580 and 669. Good is 670 to 739. Very good is from 740 to 799. And then you have excellent, which is anything from 800 to 850, the max. Now, typically speaking, your credit score is so important because the higher your credit score is, the lower interest rate you can get from a lender. Now, when it comes to taking out a loan in the first place, this is going to be for big purchases. So think about the thousands of dollars you could save each year or throughout the duration of whatever loan you have, just based off of having that high credit score. Your credit score could also determine what your initial deposit on whatever loan might be. So as you can see here, I went to investopedia.com and found that there are 5 main factors that impact your credit score. So the first and the most important one is your payment history. So on all those lines of credit that you have, are you making your monthly payments on time? If you are not and you are behind on payments, this will negatively impact your credit score. So one way you can prevent this from happening is by automating your payments or setting due dates in a calendar of some sort in order to remind you to make those payments. It's also important whenever you do take a look at your credit score, you might have some errors in your credit score report. So getting those errors taken care of and removed will serve dividends for you. The second is your total debt owed. So when you take out a new line of credit, the bank has to analyze to see if you can actually afford to make these new payments. It's called your debt to income yield. So how much are you making each month and how much do you owe on all your debt? And then they have kind of like an umbrella number where they calculate, all right, how much are you paying for rent? How much are you paying for most of your common expenses? And then looking at how much debt you have to see if you can actually afford this new line of credit. The third, which gets a lot of younger people, is called the length of credit history. So how long have you had credit history for? And there are many programs now today that help and calculate other factors that aren't normally put into calculating your credit score in order to help new people in the market purchase homes or cars or whatever they desire. The fourth is known as new or recent credit. And this also pertains to hard inquiries and soft inquiries of your credit. So a soft inquiry is one that will not affect your credit score, but a hard inquiry will. And you typically take out a hard inquiry for, let's say you're looking to get a new credit card, you're looking to get a new auto loan or a mortgage. Number 5 is your types of credit. So this is your credit mix. So it's how diversified is your credit load? Are you just purchasing a whole bunch of cars, or do you have a credit card? Do you have a mortgage? Do you have a student loan? Just seeing how diversified that portfolio is, if you want to say. Now, all these different factors that the bank looks at in order to determine your credit score have a different weight. Your payment history is going to be your greatest factor in determining your credit score. This is about 35% of your overall credit score. Now, obviously, this is very important to lenders because it shows, do you actually make your payments on time? The total amount owed counts for 30% of your overall credit score. Now, this also accounts for the amount of credit that is available to an individual and what percentage of that credit they're actually currently using. The percentage of the credit that's available to you that you're using is what's known as your credit utilization. Next, what lenders are going to do is look at the length of your credit history, which accounts for 15% of your overall credit score. Now, the longer your credit history is, the better it is for lenders to see, because that means there's more data they can see and collect from to see how well you are at paying off your payments on time. Banks also like to look at the types of credit you have, which accounts for 10% of your overall credit score. So typically speaking, some loans have higher risk than others. For instance, a personal loan, a payday loan, a credit card loan are going to have a lot higher interest rates because the likelihood of an individual defaulting on those are higher than, let's say, a mortgage, which will have a lower interest rate. Also, when a lender gives out money to a borrower for something like a home, they know that they have the home as collateral. So let's say you don't make those payments, they can foreclose on that home and then sell it in order to get their money back. The final thing that lenders will look at is your new credit. New credit counts for 10% of your overall credit score. Typically, what negatively impacts most borrowers are hard inquiries. Let's say, for example, you made a bunch of hard inquiries within a short period of time in order to find the best terms in order to purchase a home. Now, this is seen as you trying to expand your current available credit. Honestly, I don't personally understand it that much, but it's seen as a greater risk to lenders. Now that you know what lenders are looking at when they determine your credit score, you can use this information to help build your credit score up. There are also plenty of credit repair companies that can help you out. So if you have any more questions, just leave a comment below and make sure to subscribe and like. See you next time.